The gentleman from New York, Mr. Garbarino, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman Grunberg, I want to talk a little bit about Signature Bank. Can you describe the condition of Signature Bank at the time of its receivership and what evidence you had that showed Signature was also facing a liquidity crunch on March 10th? And what was Signature's available funding at the time New York State DFS closed the bank and placed it at FDIC receivership?
Congressman, we can get you the specific data, but the fact is that on Friday night, that bank had real difficulty meeting its obligations at the end of the day and barely met them by the 5:30 closing time. And I think both New York State and the FDIC, who jointly had responsibility, did not think that the bank could open and make it through the day on Monday. I think that was the determination. And that's why New York State on Sunday decided to close the institution.
All right, and you can get me the specific numbers?
Yes, we can.
Thank you very much. And now I want to focus, I want to follow up on something that my colleague Tom Emmer asked before. When New York Community Bank Corp. assumed its Signature's deposits in some of its loans, it refrained from including roughly $4 billion of deposits related to Signature's digital assets banking business. As a result, Signature's real-time payments network remained under FDIC Commission's receivership. It was reported early yesterday evening that the FDIC sent a notice to depositors whose deposits were not included in NYCB's bid, informing them that any accounts not closed by April 5th will be automatically shut and depositors will receive a check in the mail. Can you walk me through FDIC's reasoning for this decision?
Yes, Congressman. So the winning bid for Signature by New York Community Bank's subsidiary, Flagstar, was for all the deposits except the winning bid chose not to bid on the digital assets. And there were about $4 billion of those. And we provided those depositors a couple of weeks to determine what they might want to do. And we sent them a notice that we'll return their deposits to them by early next week, I believe.
So in your response to Tom Emmer, you mentioned that Signet was included in the sale of Signature Bank, while the deposits were not. It is my understanding that you still currently are looking for, so you're still currently looking for a buyer.
So just so I'm clear, the digital deposits are being returned to their deposit holders. It's my understanding that Signet was not acquired and remained in the receivership, and it's in the process now of being marketed. So
Signet is still under FDIC
yes,
receivership?
It's in the process.
Thank you very much. Chairman Grunberg, I also want to bring this up. In the Senate banking hearing yesterday, there was an exchange between Senator Van Hollen and Vice Chair Barr on the guidance on guidance issued in 2018 and codified in 2021 when Randy Quarles was Vice Chair of the Supervision of the Federal Reserve Board of Governors. This has become a target of some, even though this initiative doesn't limit any action an agency can take. It simply clarifies which actions will be accomplished through regulatory measures and which through supervisory measures. You stayed silent during the entire exchange, but I recently read an op-ed in the Wall Street Journal written by Randy Quarles, which has said that both you and Lael Brainerd voted for this guidance. Is that true? Did you vote for this guidance?
Yes, we did, Congressman.
Okay. Thank you very much. And I have one more question. Sorry. Vice Chairman Barr, as we look back at the events over the past couple of weeks, there have been a number of similarities identified between Silicon Valley Bank and Signature Bank. The first of which is being the high concentration of deposits well above the FDIC insurance limit, with reports showing that 90% for Signature Bank and 87% for SVB. And the second being the lack of diversity in both banks' deposits. The news has discussed the potential impacts of these similarities ad nauseum. However, I would like to explore how the Federal Reserve and the FDIC view deposit diversification as it pertains to determining the soundness of financial institutions.
Sorry, I couldn't hear the last 4 words of your sentence.
I would like to, and I'm out of time, so I'll submit this question for you to respond on the record. Thank you so much.
The gentleman yields. The gentlewoman from Georgia, Ms. Williams, is recognized.
Thank you, Mr. Chairman. I want to start by making it clear that the failures of the Silicon Valley Bank and Signature Bank were not just about wealthy people, as some of the narrative that we've heard in conversation. There is a significant chance of a disastrous impact on hardworking people who are trying to make payroll, and it's important that this detail doesn't get lost in the shuffle. The weekend that SVB failed, I woke up to text messages from constituents asking what the government was going to do, what kind of intervention there would be, because they had money in this bank. Atlanta is this booming area for tech startups, and so the impact was felt very real by my constituents. They wanted to know if they would be able to access their funds on Monday morning. Black-owned businesses were worried about paying their employees. Entrepreneurs who are creating wealth in marginalized communities were concerned about covering basic business expenses. These businesses are closing the racial wealth gap, which unfortunately my home district of Atlanta leads the nation, and the banking system has to work for them. Chair Gruenberg, in the aftermath of SVB's failure, there's been substantial debate about raising the $250,000 deposit insurance cap to minimize any potential payroll disruptions and economic pain that may follow when the next bank fails, which my constituents were so concerned about. There is reportedly bipartisan legislation in the works to temporarily raise the cap. If the cap is raised or eliminated to help protect depositors, we'll need to take measures to reduce the risk of moral hazard. One proposed measure is the continuance of risk-priced deposit insurance premiums. Chair Gruenberg, as we consider different deposit insurance reforms, should we seek to maintain risk-priced deposit insurance?
Well, I think we do want to maintain risk-priced deposit insurance, but I do think, you change one part of the system, it impacts another part of the system. So, as I indicated earlier, the FDIC is undertaking a comprehensive review of the deposit insurance system in light of this episode, and will release a report by May 1, also laying out policy considerations for changes to the system that we hope will inform the discussion around this.
So beyond the report, moving forward, what steps can the FDIC take when making decisions about deposit insurance assessments to make banks think twice about various financial stability threats that disproportionately impact marginalized communities?
Well, we have authority now to do risk-based pricing, and I think it's fair to say that in light of this experience, we need to think hard about liquidity risk and concentrations of uninsured deposits and how that's evaluated in terms of deposit insurance assessments. But I also think it's an appropriate moment to take a look at how our system works in light of of this episode, and consider what other changes might be prudent.
Thank you. And we all know that part of maintaining a healthy banking system is confidence, specifically consumer confidence that their money is safe in the banks that they've chosen. People of color have a harder time getting affordable loans from the largest banks and thus turn to the community banks, minority depository institutions, and the like. And when there is fear in the financial sector or an economic downturn, minority-owned banks and community financial institutions are hit hard as customers transfer their funds to what they think are safer and larger banks. Vice Chair Barr, what can Congress do to strengthen and support community and minority-owned banks in situations like we just experienced?
Thank you very much, Representative Williams. I agree with you that having a wide diversity of kinds of institutions in our country is really critical, including community banks and regional banks, minority depository institutions, and community development banks. All of these institutions, I think, are really important for economic vibrancy and inclusion in our society. We'd be happy to work with you on ways that we can continue to support those institutions going forward.
Happy to work with you, and we will definitely follow up. And Chair Gruenberg, I would love to hear from you what kind of deposit insurance reforms would help support minority depository institutions and other community banks.
It's an interesting question. We're in the process of finalizing a major revision of the Community Reinvestment Act, and in the proposed rulemaking, there were specific provisions to encourage banks to work with and support minority depository institutions and community development financial institutions. So I think that's actually an important vehicle and opportunity to strengthen our MDIs and CDFIs, which which serve LMI communities. And it's an interesting, we should give some thought in our review whether how deposit insurance may play into this as well.
And I have many more questions, but we're going to work together on this, and my time has expired. Thank you, Mr. Chairman. I yield back.
The gentlewoman yields. The chair now recognizes himself for 5 minutes. Vice Chair Barr, did you originally believe that inflation was temporary and transitory? Yes or no?
I was not on the Federal Reserve Board at that time.
Did you believe it was temporary and transitory, or you had no opinion?
I would say at that time I did not have an informed opinion.
You did not have an informed opinion if it was temporary and transitory. The Federal Reserve continued to call inflation temporary and transitory until Q4 of 2021. The Biden administration continued to call inflation temporary and transitory. I apologize, the Federal Reserve Q4 of 2021. Biden administration Q1 of 2022, following the Russian invasion of Ukraine. That's when they stopped calling it temporary and transitory. Would the challenges that we saw with SVB have taken place if inflation truly was temporary and transitory? Yes or no?
The problems that came about from SVB are from classic interest rate risk management.
So if inflation was temporary and transitory, then I will make the assumption on your behalf for myself that interest rates would not have gone up. If interest rates didn't go up in the manner and hold in the way that they are, SVB would not have occurred. The breakdown of the bank.
Sir, banks have an obligation to manage interest rates, whether they're going up or going down. It's just classic good banking, and it wasn't done here.
Okay, so let me dive in then. Yesterday, in response to a question from Senator Rounds following the matter requiring immediate attention, the MRIA, you noted that there was a challenge in the model, that it was, quote, was not at all aligned with reality, end quote. Was that a challenge in modeling in particular interest rates? Or what part of reality was it not connected with?
Let me also say, as I mentioned earlier today, I called that an MRIA yesterday, but I meant an MRIA. It was just a staff note
Understood.
mistake. So it's an MRA on interest rate risk. And basically what I meant is that their model showed that they'd earn more money as rates were going up and they were losing more money.
So interest rates was at the core of how it was disconnected from reality?
Yes, it was about interest rates.
That's fair. So here's my challenge. So as I look at the ability to prevent all of this, the Federal Reserve would have had to admit that they were wrong, that inflation was temporary and transitory. I think that's at the core of our conversation here. And Congress, I think, continues to do an abysmal job with the administration to bring inflation under control. Let me switch gears if I can, pretty substantively here, Vice Chair Barr. I have in front of me the H-41 from the Federal Reserve, and in particular looking at the loans that the Federal Reserve has made to depository institutions. There's been a significant shift in particular as relates to other credit extensions. Other credit extensions is noted is that the Fed is taking collateral from the FDIC. That account, March 9, $0. March 16th, 1 week later, $57.6 billion. March 23rd, 1 week after that, $178.6 billion. So the Federal Reserve is taking collateral from the FDIC and loaning the FDIC money. Under what statutory authority is the Federal Reserve engaged in that?
Sir, the Federal Reserve is lending through the discount window to the bridge institutions that were established by the FDIC. So they're lending to banks. There's a provision in the statute that clearly contemplates that.
And so you're noting that when I read footnote 7, that would not have fallen under the line of either primary credit or secondary credit?
For the purposes of enhancing transparency to the public, that line was broken out so that everybody could see exactly what it was.
Okay, that is helpful. Then if I can shift to you, Chair Grunberg, as we look at this dramatic increase, is there a reason that you used this facility rather than one, selling assets, or two, tapping your line of credit at the Treasury, which I believe is to the tune of $100 billion?
We certainly have sold assets to meet our liquidity needs, and these bridge institutions are nationally chartered banks eligible to borrow from the Fed and utilize that in order to manage the liquidity situation as well.
But is there a reason that you're not either A, utilizing in a more substantive way the credit line available from the Treasury, or B, selling assets? And the reason I ask this, so maybe I can be more specific, does the FDIC have this same risk that we're seeing in other banks with unrealized gain or unrealized losses? And is that why you're tapping this facility rather than selling assets?
No, Congressman, we are selling assets to meet the obligations of the failed institution, and we're also managing the liquidity. These bridge banks have the authority and ability to access the Fed resources.
So you're both selling assets and borrowing from the Fed to the tune of $178 billion at the same time?
For these institutions to meet immediate liquidity demands, which we'll eventually get back.
And did the Treasury at any time discourage you from taking a loan from the line of credit from the Treasury for purposes of addressing the debt ceiling limit?
I think there were discussions in regard to that, but I think the principal purpose here, frankly, was liquidity management and also to be able to preserve liquidity in our deposit insurance fund.
I appreciate your time here today. I yield back. I'll now recognize the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for being here with us today. People in my district are already living paycheck to paycheck, and they're worried about making ends meet. They're already dealing with the rising costs of everyday goods and services, and the last thing they need to worry about right now is their bank or their employer's bank failing. That's why I'm working to provide transparency and accountability to this process. Where were the regulators? I want to know what the bank executives were doing in the months, weeks, and days leading up to this failure. My constituents deserve to know that we're going to hold bank executives accountable and ensure that this doesn't happen again. These bank failures rattled our financial system. Working families in my district need a stable economy they can rely on. They can't afford more uncertainty when it comes to their next paycheck. And right now, the looming debate over the debt ceiling crisis has the ability to rattle our economy even further. So, Vice Chair Barr, in just a few months, the United States Congress needs to raise the debt ceiling. If the U.S. defaulted on the debt, would it be really bad for our economy? Would it be really, really bad for our economy? Or would it be really, really, really bad for our economy?
The basic answer to that question is that Congress needs to increase the debt ceiling, that there's not other options around that. In the absence of an increase in the debt ceiling, it could cause enormous dislocation to our economy.
So 1 really, 2 reallys, 3 reallys?
I wouldn't characterize it. I think that it's the right thing to do. I think Congress needs to do that, and really I leave anything else about the debt ceiling up to discussions between the administration and Congress, just to say from an economic perspective, it would be quite unfortunate.
Thank you. Vice Chair Barr, the second largest banking failure in the United States history, $42 billion pulled in a day. Who was asleep at the wheel?
I think in the first instance, as I've said, bank management is responsible for running the bank. They failed in basic measures of interest rate risk and liquidity risk. They had very many outstanding matters requiring attention, matter requires immediate attention. They were deficient in governance and controls. They were rated a 3 overall with respect to the firm, which means they were not well managed. And at the end of the day, it's the job of the bank and their board of directors to run themselves the way they should. We, of course, are looking internally at our own supervision and our regulation in looking at ways that we could have forced the firm to do more faster or raise standards so that if the firm got into trouble, they had more capital and liquidity.
I certainly hope there's some accountability. Chair Gruenberg, moving to you now. First Citizens Bank, which is located in my congressional district, North Carolina's 13th district, was the successful bidder for Silicon Valley Bank. They have a proven track record in this space and are already instilling greater confidence in our banking system. Can you tell us about the evaluation process for the bids that were submitted and what made First Citizens the most attractive bidder?
2 reasons, I'd say, Congressman. One, financially, it was the strongest bid for the FDIC. And 2, it was a bid for all the deposits of the institution and all of the loans of the institution, so that it provided operational certainty as well. So from both a financial standpoint and an operational standpoint, it was really the strongest bid we received.
And it took a while. Why wasn't Silicon Valley Bank purchased sooner? I think that certainly would have created more stability in this situation.
If we could have sold it that first weekend, that would have been desirable. The fact is, Silicon Valley was a pretty large institution, $200 billion in assets, and pretty complicated in terms of its business activities. So for a potential acquiring institution to do the due diligence over a weekend and reach a conclusion and make what was frankly not practical. And so we set up a bridge institution and for both of the failed banks, and we're able in a pretty orderly way to set up bidding processes for each. In fact, for Silicon Valley, we had considerable interest and got a couple of requests for additional time for interested parties to do due diligence. So we extended the bid date a couple of times to give people time, and we ended up, getting, I think, 27 bids from 18 different sources. So it ended up being a pretty constructive process.
Thank you very much. I yield back.